Hey guys, this is James and I wanted to intrinsically value Nvidia in my discounted cash flow model using my grams model and dividend discount model. So in this calculator right here, we value intrinsically various stocks using the free cash flow numbers and putting everything into the calculator, and it spits out a valuation for these three valuation models, averages them together. We apply a margin of safety of anywhere from 25 all the way up to 50%, get the final valuation and compare it to the current price. And once we're all done, we click go and it gives us a buy or sell signal just based on where the final valuation is. If it's above the current value, it will say buy, and if it's below, it will say sell. And current P/E ratio of Nvidia sitting at 117, current yield and payout. And I was very interested in seeing what the discounted cash flow model and grams model would spit out for Nvidia, as we've had an extreme price advance over the past year for Nvidia, all the way from $116 all the way up to about $485 at the current price. And with the recent earnings report for Nvidia here, August 23rd, 2023, we have had major record revenue advances, up 88% from quarter one and up 101% from a year ago, and record data center revenue. So a large portion of their revenue is coming from selling into data centers, selling their chips into data centers, up 141% from quarter one and up over 171% from a year ago. And another thing I'd like to point out, what they're doing with their shares. During the second quarter of the fiscal year of 24, Nvidia has returned $3.38 billion to shareholders in the form of buying 7.5 million shares, repurchasing those shares, and giving some of this money back in the form of a cash dividend. Now, their dividend is very small, and it's very possible in the future, as their growth starts to slow down, they might increase their dividend yield, as they are producing a ton of cash. And I just wanted to highlight this here over on Seeking Alpha's earnings page. We'll come back to Seeking Alpha, but over here on their earnings page, you can see the past 4 quarters. Here is their earnings per share. So they missed it about a year ago in quarter 3 of 23, or fiscal year of quarter 3 23, and their most recent fiscal quarter 2 of 24, they beat it by 63 cents, and they are expecting another large increase here, and I believe the next earnings date is at the beginning of November 2023, and they're expecting a almost 500% year-over-year increase compared to this current quarter compared to last year's quarter. So what this is saying is they're expecting a $3.35 earnings per share compared to 58 cents earnings per share. And then they're continuing to see an increase over the next 4 quarters for Nvidia. So it doesn't look like Nvidia is going to, at least by the analyst's perspective, that Nvidia is going to be slowing down anytime soon. It might seem kind of contradictory to continue to buy into Nvidia, but if their earnings per share is not slowing down and their revenue growth is not slowing down, I see no reason why Nvidia would tank, unless there's some type of macroeconomic situation that would cause the entire stock market to go down. But back over on the calculator, and you can get access to this calculator over on my Patreon, and I'll walk you through how you get all these numbers for each model, a little bit about this calculator, and then, at least for the purposes of this video, we're going to find out what this calculator tells us for Nvidia, and I think you're going to be kind of surprised. So for the discounted cash flow model, we have to find the 10 most previous years of free cash flow, what type of cash flows they have. So going over to Nvidia's tab on Seeking Alpha, under the financials, under cash flow, we have the previous 10 years, and we have the 12 trailing months of free cash flow. If we come to the bottom here, free cash flow per share. So taking a look at this graph right here, it doesn't take into account all of 2023 as of yet. So what I did was I took the 12 trailing month figure and then went back 10 years from here and then multiplied this dollar per share by the total number of outstanding shares to get the free cash flow number for the most recent 10 years. So $4.17 multiplied by the number of outstanding shares starting right here gives us $10.3 billion for the 12 trailing months. And then going back with those same figures that we got on Seeking Alpha, multiplying each of those free cash flow per share figures multiplied by the number of outstanding shares, and we get free cash flow for the previous 10 years. And this is what it looks like. We have a extreme slope in the upward and right direction. That gives us an average growth of about 40% growth over the past 10 years averaged free cash flow growth. So what do we put in perpetual growth rate and discount rate? Well, typically I'm going to keep it under 1% for perpetual growth rate, and I'm going to say 0.5%. This is saying if the company grew off into infinity, what would you expect them to grow every single year? And typically it's going to be under 2 to 3%. The US economy grows at around that 2 to 3% per year, so we'll keep it under that. Discount rate is basically saying if you were to put your money anywhere else, what type of return would you like to receive? And let's say 8%, which is very typical for a discounted cash flow model. Cash and debt, we can find these figures over on Seeking Alpha as well. Over on Seeking Alpha's valuation tab at the bottom, total debt $10.95 billion, total cash $16.02 billion. Having that into the calculator, we are done with the discounted cash flow model. And how I set up all my calculators, I have video instructions here over on the overview tab for each and every calculator I build. How I set them up is yellows are the inputs, the things you play with. Greens are the outputs. You don't touch them. They will be calculated by themselves. So here in the white, we just finished the DCF model. We'll find out the valuation once we click go here. Now Graham's model. What I simply do for this is go over to Yahoo Finance. Over on Yahoo Finance under the analysis tab, come down to the bottom and the growth estimates. Now for Graham's model, putting in growth estimates, you have to estimate the growth, what you expect the company to do over the next 5 to 10 years, and analysts are expecting about 78% growth per year. So we put in 78.7 for Graham's model. AAA corporate bond rate, that is a simple Google calculation. Now, the thing with Graham's model, it's going to spit out a fairly low number, but we're going to do some tweaking based on the earnings estimate. So what Graham's model is going to do is pull the previous diluted earnings per share figure, and that's going to end up to be about $4.14 per year. So I think it's going to take the previous 4 earnings per share, but I don't think that's going to be accurate. We're trying to project what the earnings per share is going to be in the future. So the future earnings per share, let's say January 2024 right here, estimate 10.82, January 25, 16.01. So we'll come back to that once we click go on the calculator. It's going to give us a low number. We're going to adjust the earnings per share, and that'll give us a more accurate Graham's model estimate. Now the dividend discount model, I did fill this out right here, and you can find this information. I'll walk it through with you, but we are going to disregard this valuation technique for Nvidia because Nvidia is not paying a cash dividend. That's not where they're putting their money at. They're putting all their money at in growing the business, not paying a dividend. This is not going to give an accurate valuation for Nvidia. But if you wanted to use this calculator and you wanted to value other good dividend paying companies like dividend aristocrats like a Coca-Cola or a Philip Morris or an Altria, this would be a good valuation for that. But where do I get this? Oh, back over on Seeking Alpha under their dividends tab and dividend scorecard, taking the annual payout at 16 cents per year, 5-year growth rate 1.64%, and just taking a peek at their dividend history. And remember, they are buying the shares back and paying you a dividend, and they've been paying a 4-cent dividend for the past few years, and it's very possible as the growth slows that they would increase their dividend. Coming back over here, putting in that 16 cents for dividend payout, 1.64% for 5-year dividend growth rate, risk-free rate, or the 10-year bond yield. That's a quick Google. It's sitting around 4.2%. And return of the market anywhere from 8 to 12%, whatever you expect the market to return. So with all this into the calculator, let's go ahead and click go. So let's kind of analyze what this is telling us here. The dividend discount model, obviously we know that Nvidia is not taking their cash and paying you in a dividend just yet. So they're just continuing to pay that 4-cent dividend. So we're going to take this out of the equation. When we do that, we now have an average for the discounted cash flow. It's valuing Nvidia a price target of $960. So we're sitting at $485, and a discounted cash flow model based on their free cash flow, discounted cash flow model is saying that Nvidia is worth $960. Graham's model right now, based on the previous 4 earnings reports, which is about $4 for the total year, $4 per share. It's telling us that Nvidia is valued at $318. But let's go ahead and look forward. Now this is a little tricky since this Graham's model is built into the calculator. What it's doing is pulling the earnings per share here under the Google Finance at $4.14. We are going to take the analyst's estimate of around $10 earnings per share, and we're going to see what it would be at $16 earnings per share. So let's go ahead and erase this out of the equation and put $10 earning per share in and see what it gives us. Graham's model is now evaluating Nvidia at $769, an extreme, even at 25% margin of safety, final valuation of a price target of $648, and Nvidia sitting at $485. They would have to seriously miss on their next earnings report right here. They would have to seriously miss, even if they beat the $2.70 here in the blue, even if they beat that, and they miss their $335, they're still well on their way to $10 earnings per share. So even if they miss, you might see a dip, but I think it would come right back. Another reason why this might not hit this 648 figure is maybe we have another macroeconomic situation, whatever that would be, a poor jobs report, something in the political space, or the U.S. Debt repayment is downgraded like what happened here in August of 23. Whatever it may be, you might see a dip. But if Nvidia is continuing to meet these marks of high earnings per share and a large year-over-year growth in earnings per share, I don't see Nvidia taking any dips anytime soon. So taking that into account, let's say that $10 earning per share is applicable over the next course of the next year, we're sitting at an average valuation of anywhere from $648 with a 25% margin of safety all the way up to $865, and we're only sitting at $485. So we got a lot of room to grow. Let's say in 2025 we're expecting their earnings per share to be 16. That gives us a valuation of about $1,200 for Graham's model. So let me know what you thought of this valuation technique. Let me know what you thought of this analysis, and if you are continuing to keep Nvidia in your portfolio, if you are selling it off, or if you're continuing to add or pyramid to your Nvidia holding. Let me know. If there's another stock holding you'd like me to analyze in this fashion, head down into the comments and let me know your 2 cents. And if you would like access to this calculator, I have it available over on my Patreon, and I also over on the overview tab, I do have video instructions for each calculator. With that, thanks for watching.